Hello and welcome to Morning Markets. I'm Roger Peterson. Thank you very much for joining us. Here are some of the stories we are tracking for you now in the BNN Bloomberg newsroom. Chorus Entertainment saw revenue drop 18% in its most recent quarter as a prolonged advertising slump continued to weigh on the company. Chorus posted a net loss of more than $11 million, with TV revenue taking the biggest hit. On the upside, the media company says the completion of its proposed recapitalization transaction will deliver substantial balance sheet improvements. Luxury retailer Saks Global has filed for bankruptcy. The American company is preparing to reposition itself after obtaining about $1.8 billion US in financing commitments. Saks' top executive stepped down earlier this month as the firm struggled with debt from its acquisition of Neiman Marcus in 2024. The retailer is also facing increasing competition. Oil major BP expects to take a hit of $4 to $5 billion US in the fourth quarter, mainly due to impairments in its low-carbon energy business. The British company slashed its annual spending on energy transition businesses about a year ago. BP is redirecting spending to oil and gas to boost returns under the new leadership. The energy company also warns weaker oil trading and falling prices will weigh on fourth quarter earnings. And taking a look at the market, struggling for a second day in a row. The TSX down right now about 0.4%, but still hovering well above 32,000 in or near record territory. And looking down south, the S&P 500 off by nearly a point. The Dow Jones down by 0.56 and the Nasdaq off by 1.46% right now. Again, looking at another losing day there as well. Earnings from American banks are rolling in this morning. Bank of America, Wells Fargo, Citigroup all seeing some pressure. However, our next guest says Bank of America and Citigroup both posted strong quarters and good outlooks. Here to break it down for us is Mike Clare, Senior Vice President and Senior Portfolio Manager at Brompton Funds. Mike, thanks very much for joining us.
Yeah, thanks for having me.
We're seeing them off for the morning, but overall you're saying they look pretty good. Let's start with Bank of America.
Yeah, sure. Looking at, Bank of America, I think the results for the quarter were pretty strong. They had a moderate earnings beat driven, I think, by strength across several of the businesses. So you're looking at like net interest income, which is core lending business, was ahead on loan growth and some moderate expansion in margins. We saw pretty strong capital markets results with strong trading revenues. And investment banking revenues, notably advisory fees, were ahead by about 20%. Investment banking in the second half, management highlighted, was up about 25% versus the first half. Bank of America, of course, has a pretty strong wealth management business that is performing well. And notably, like credit across all of the banks is performing well with benign credit environment. Credit losses generally sort of down versus the prior year. I think what's concerning the market is like the outlook looks good. Mm-hmm. Guidance was roughly in line on interest income. With Bank of America in particular, they're guiding towards 200 basis points of operating leverage, which is implying that revenue is going to be growing faster than the expense line. I think that's a little bit weak relative to what the market was expecting, and that's driving some of the weakness in the stock today. As we've seen with JP Morgan yesterday and again with some of these banks today, I think the market is laser focused on expenses, expecting expense efficiencies in 2026 and into later years. We think the reaction is probably a bit short-sighted. I think when you see banks like Bank of America and JP Morgan, investing in the business, they're investing in growth. It's a great environment for banking. across core banking businesses and capital markets, investing in technology, which should set the stage for cost reductions in the future. We think having operating leverage come in maybe 100 basis points below expectations and then having the stock sell off is probably a little bit short-sighted. And notably, there was, in the analyst call, there was a bit of a feisty back and forth on that as well.
And what happened there? Like, is this a case of expecting perfect, almost a lot like the Mag 7? If you're not bigger and better than what we wanted, then you failed?
Yeah, that's one of the other things we're seeing is, of course, you look at bank reporting over the past year. The results have been very good, and there have been some very strong beats relative to expectations in past quarters. And I think expectations have now caught up to some extent. So when the banks only have a moderate beat, a lot of good things are priced in. You do see some weakness in the stock. But again, we think that's somewhat short-sighted given the positive macro backdrop for banking and the positive outlook for particularly the U.S. economy in 2026.
All right, let's talk a little bit about Wells Fargo and Citigroup, and then get a bigger picture. Wells Fargo, what did you like, not like?
So this was, I think, describe it as an okay quarter for Wells Fargo. Generally, revenue, net interest income, drivers of the business are roughly in line with expectations, which is again not enough to drive a positive reaction in the stock. What we like is they've demonstrated some pretty good results on expense management. So their expenses over the course of 2025 were actually flat, which is pretty good in an inflationary environment we're seeing. We're also seeing them sort of get back to balance sheet growth. Of course, Wells Fargo was under an asset cap up until earlier last year. And so now we're seeing them, invest in the business. Their net interest income guidance for next year is resulting in something like 5% growth, with expenses largely in check. We should see loans growing in the mid-single-digit range, deposits, along the same lines there. So it's like an okay quarter for Wells Fargo, but not enough to really drive a positive reaction in the stock.
All right, and Citigroup.
Citigroup, we thought was a great quarter. We saw there are a few, one-time items in there, like they announced a loss on the sale of this business they've got in Russia, which was actually announced in December, so it's nothing new. But if you take that out, they had a pretty solid beat driven by momentum across a number of their business lines. One area of Citigroup that we really like is they call it their services business, which is essentially banking for large multinational corporations, looking at cross-border treasury management, payments, and other things like that. That saw pretty good results, up 15% year over year, well ahead of expectations. And management highlighted things like deeper client relationships and new client mandates that are driving that business. We also saw fantastic results in investment banking, with advisory fees up 84% year over year. That's something where we see continued momentum in 2026. Generally, good result for the business.
All right, and just want to talk about I don't know if it's even a potential headwind, but it's been bandied about. It's Trump. The credit card interest rates being capped at 10%. He would like to see that. Is it realistic? And I mean, if it actually did happen, what kind of an impact might that have?
Yeah, I think obviously that's something that's weighing on bank share here. Our view is that this is a little more bark than bite. We don't think this is something that's possible without legislation by Congress, which we think is unlikely. Also think the policy doesn't really make sense. Credit card lending is a highly competitive business. There are a number of players in the market, so we don't think a price cap doesn't make sense in that business. And then notably, the banks are actually pushing back quite hard on this, particularly Citi, which of course has larger exposure to credit card lending than some of the other larger banks. They have some comments this morning suggesting that having a cap could result in cutting off lending to certain parts of the consumer environment, and then that could drive a significant economic slowdown as consumers lose access to credit. So we think that Trump does have a history of backing off some of these poorly thought out policies. We saw that a lot with tariffs last year, and ultimately we think they're probably looking for someone to blame when it comes to these affordability issues, and the banks seem to be an easy target. No, I don't think that there's going to be a 10% cap on credit card rates. I do think that if there was, it would be pretty material for bank earnings. But yeah, again, the banks are pushing back pretty hard here.
And any other potential headwinds you see for the next year?
No, we think, again, the environment is pretty good for the banking business. Like capital markets, we expect a pretty strong recovery there. The core lending business of these banks looks very strong. And ultimately, we think, an investment in technology today should drive positive operating leverage in the future, particularly with the deployment of AI, which has an opportunity for these banks to really reduce headcount or continue to grow without expanding headcount.
Okay, we'll wrap it up there, Mike. Thanks as always for joining us.
Yeah, thanks for having me.
Mike Clare, Senior Vice President and Senior Portfolio Manager at Brompton Funds. Just ahead, Canada's Prime Minister Mark Carney has arrived in Beijing as China presses for the removal of tariffs. More on that when we come back. Mark Carney's trip to China is the first to Beijing by a Canadian Prime Minister since 2017. He is set to meet with President Xi Jinping later this week. For more on Carney's trip to China, we were joined earlier by CTV's Rachel Aiello.
Prime Minister's main objective in his visit to China is twofold. One, hoping to reset relations with China to some degree, and then trying to find some resolution on the trade front. Obviously, China has tariffs on Canadian canola, pork, and seafood, and Canada has a 100% tariff on Chinese EVs. Now, senior officials who were briefing reporters in advance of this trip, Andrew, were indicating there is a reasonable expectation that there will be some resolution on the trade irritants, but not a full lifting of tariffs. And then we heard from Foreign Affairs Minister Anita Anand when they touched down in Beijing this morning, evening their time, indicating that there are several other opportunities for ways for Canada and China to collaborate beyond trade. So we'll see what other potential memorandums of understanding or other investment agreements are able to be reached over the next few days. But in terms of the economic side of things, that's really where the Prime Minister is focusing his attention in these meetings, including that key one with Xi Jinping on Friday.
And just give us an idea of any other sore points or touch points that will come up with the Chinese leader.
Yeah, so obviously relations diplomatically between Canada and China have been tense for a number of years, largely tying back to the arrest of Huawei executive Meng Wanzhou and then what officials called China's arbitrary detention of the two Michaels. That all seeming to resolve to a certain degree in 2021, but since then there's been new focus on issues like foreign interference. So officials were indicating that the Prime Minister is in the habit of, when he's meeting with other world leaders, bringing up human rights concerns and consular issues. But I think given the Prime Minister's pragmatic approach, as it's been largely described, will be interesting to see if he takes the risk of raising more sensitive issues like foreign meddling, or if he's going to try to use this small window of time in China and that key face time to try to make progress on other files and not get into some of the other more sensitive touch points.
And that was CTV's Rachel Aiello. Now, for more on Carney's visit to China and how it aims to achieve expansion in Canada's pool of international trading partners, we were joined earlier by Kash Pashutan, CEO of First Avenue Investment Council.
It's upwards of 10 years since it's happened in the past. I think more than the trip is the timing of it is really interesting. And I think for Canada, in some ways, I think we need to be careful here because obviously from a geopolitical lens, I would hate for us Canadians to be viewed as sort of forming an alliance with China at a time where relations are very sensitive from U.S. to China. And as we know, President Trump and the current administration picks sides and picks teams, and if you're not on those teams and on their side, then often it's a challenging ride. And so the last thing we will want as Canadians is to have our neighbor in the U.S. View us as being on China's side and make Canadian-American trade relations even more difficult.
I mean, we saw Trump yesterday say we don't need cars made in Canada, and he called Kuzma irrelevant. It really is a delicate balancing act that the prime minister's doing right now.
Yeah, and listen, I'm certainly no politician, but I think that the U.S. is a mega force as we know it. And given that they're our neighbor, if you're asking my view, I think we should be spending time and energy trying to repair that relationship and not snubbing it, because at the end of the day, we need the U.S. and certainly that everything has been put on hold. We could talk about the reasons why discussions fell apart, but it's almost irrelevant at this point. I think we need to really be focusing on getting the Canadian-U.S. relationship back on track. And the reality of it is, whether we like it or not, Canada needs the U.S. a lot more than the U.S. needs Canada. We're seeing evidence of that almost on a weekly basis. And so if we're looking at what's best for Canada as we move forward here, trying to elbows up or show the U.S. that we don't need them is, in my view, a very emotionally driven approach. And we should get back to focusing on getting that American-Canadian relationship back on track, which, as we stand today, feels like a very, very far objective.
But how do you work on repairing a relationship with Donald Trump? Sometimes it doesn't seem possible.
Yeah, I mean, I got to tell you, I know that is the narrative out there, but at the end of the day, no one likes to negotiate a deal more than President Trump. And so, it comes down to the negotiation. He's cutting deals on an hourly basis, on a daily basis. And so I think we can say that we can't negotiate with them, but maybe some people can't, but many people can. And at the end of the day, if maybe Canada won't have as good of a deal as it did before, but a deal that is not as good as before is better than no deal. And time is going by. The U.S. is not waiting for Canada to decide to negotiate and do a deal. I mean, we're seeing it. So I think Canada is being left behind in the dust while the U.S. continues to move forward. And I don't think it's serving Canadians well. I think we need to get back to negotiating a deal. It felt like Prime Minister Carney and President Trump were close to a deal, and then things fell apart. Someone's got to take the first step. And again, I can't comment on things that I don't have sort of insider information on, but to be going to China right now, where we need to be focusing on getting the Canadian-U.S. trade relations back on track, it just, as an outsider looking in, it does not feel like that is a priority.
And with China, what concerns do you have if we do strike any deals with them?
Well, look, I think if, again, I'm speculating here, but in my view, it looks like if you're either a friend of the United States or you're the enemy. And I think Canada has to be very careful here to not be viewed by the U.S. as parting or forming an alliance with any party that the U.S. views as being an enemy. And so the last thing we would want to do is be put into that bucket. I think Canada has gone from being an ally to the United States to neutral, and we want to go back to the ally bucket. We certainly don't want to go to the other bucket, which is a competitor or an enemy. I mean, you could put whatever label on it, but certainly not an ally. So we're probably in the quasi-neutral bucket or territory right now. I think as a Canadian, we all want to see Canada-U.S. relations get back on track and get back to the ally bucket. Okay. I don't know, talking to China right now and forming a buddy-buddy friendship system, and I'm not saying that's necessarily happening, will do that for us.
That was Kash Pashutin, CEO of First Avenue Investment Counsel. Coming up, more on the battle over electric vehicles and whether Canada should open the door to EVs made in China. That's next. Automaking powerhouse Ontario does not want cheap Chinese electric vehicles in the market, but neither does Donald Trump, and the federal government is very sensitive to the fact decisions made on Prime Minister Carney's Beijing trip could impact the all-important upcoming talks on the Canada, U.S., Mexico free trade agreement. CTV's Abigail Beeman has more.
Touring a Ford plant in Detroit, the U.S. president gave upcoming North American trade talks a shrug.
It's irrelevant to me. Canada would love it. Canada wants it. They need it because we don't need Canada product. That's the thing. You know, I want to be a nice person, but we don't need. I want to build the cars here, not in Canada.
Donald Trump also doesn't want cheaper Chinese EVs.
Thank you so much.
Neither does Ontario's premier. Flanked by Michigan lawmakers, Doug Ford urged Mark Carney not to back down on Canada's 100% tariff on those vehicles during his trip to China.
It would not be good for Ontario and Canada, and it sure the heck wouldn't be good for the U.S., and it wouldn't be good when it comes to negotiating with President Trump.
Canadian government sources say to expect some progress on punishing canola tariffs, which China slapped on in retaliation for the EVs.
We've lost over $1 billion Canada-wide. Frankly, just even for my farm, I'm just under $100,000 myself, and that really hurts.
Saskatchewan's premier is joining for some Beijing meetings.
Would you take Mo if you didn't expect some relief, some schedule of lower tariffs on canola? Probably not.
But what EV concessions could be on the table from Canada?
I do expect that the Prime Minister isn't going there just to exchange niceties.
The head of the Automotive Parts Manufacturers Association says industry has advised the Prime Minister they can't trust the Chinese to play fair.
If Washington reacts to something we do in Beijing that makes permanent the barriers for Canadian sales into the U.S., there is nothing Beijing could offer us that could make up the difference.
In a briefing ahead of the Prime Minister's trip, federal government sources spoke of addressing trade irritants on both sides systematically, but wouldn't share details on conversations around canola or EVs.
And that's CTV's Abigail Beeman. Well, Canadians have kicked off the new year with plans to make big spending cuts. A survey found 2/3 of us expect to slash their budgets as they prepare to face a tough economic year. CTV's Quebec Bureau Chief Geneviève Beauchemin has the details of where Canadians will cut.
This Italian grocery store and sandwich counter is whimsically called Tony Bologna.
So we make small batch every day.
On the menu at this father and son shop, a focus on best quality for the lowest price.
Just like I have families to feed, they have families to feed. So the goal was to make sure that people can feed their family at a low price, but without giving up quality. The pasta, we have it at $1.75 a bag. We make homemade tomato sauces, meat sauce, and rosé, and all the classics. So you can feed a family of 4 for $7 for a plate of pasta.
That hits the spot. A TD survey found 2/3 of Canadians say they plan to slash their monthly budgets by up to $1,000 a month. 55% say they'll cut on eating out, 44% on attending concerts, sporting events, movies. Many plan other belt-tightening measures like cutting down on subscriptions and fewer retail purchases. But it seems younger Canadians appear set to make more sacrifices. A whopping 86% of Gen Z say they're preparing to slash their budget. Compare that to 43% of boomers.
They're leaning in more into their loyalty programs, into budgeting, and also into no-spending challenges, which are becoming very popular with this younger generation.
McDonald's is vying to tap into the budget squeeze. The fast food chain is freezing the price of some menu items for a year. For instance, $5 for the Meg Value Trio. This, as a recent study found more than 4,000 restaurants could close this year. At Tony Bologna's, father and son say people still gotta eat, and they want to feed neighborhood families well.
So that's why we even have all the ingredients here at the low price that you could go home and do it yourself if you want to.
And we'll have to see just how long Canadians will be forced to stick to that resolution to cut back. Geneviève Beauchemin, CTV News, Montreal.
Coming up, what's going to happen to all the empty Bay stores across Canada? We'll talk it over right after the break. Prime Minister Mark Carney is in Beijing, marking the first visit by a Canadian Prime Minister to China in 8 years. Carney will meet with senior leaders Thursday ahead of a one-on-one with President Xi Jinping. Discussions are expected to include trade, energy, and international security. Beijing has proposed easing restrictions on Canadian canola if tariffs are relaxed on Chinese-made electric vehicles. Bank of America shares are under pressure today. They're down nearly 4%. Fourth quarter net interest income topped estimates, and revenue from equity trading rose 23%, but investors seem focused on expenses. Some analysts note the bank's expectations for net income to grow up to 7% for the full year suggests expenses will be worse than expected. And shares of Citigroup also trading lower. They are down about 3.2%. Fourth quarter profit fell 13% after the U.S. lender took a $1.2 billion loss selling its operations in Russia. Market revenue as a whole also saw a decline compared to the year before. On the upside, there was an 84% surge in financial advisory fees, with revenue from handling mergers rising to an all-time record. And looking at the markets, the TSX kind of clawing its way back. It was down almost a percentage point earlier, but it's off by about 0.06, pretty much a wash at this moment. And south of the border, a lot of red there as well. You can see the S&P 500 up by 0.75%, a little bit under that. Dow Jones 0.2 roughly, and the NASDAQ taking a hit, off by 1.25%. It's been nearly a year since Hudson's Bay announced its bankruptcy, and landlords of the company's former properties have been struggling to determine what to do with this massive real estate vacancy in their buildings. Let's get more on this from Dwayne Render, City's studio director and senior associate at Gensler. And Dwayne, thanks very much for joining us.
Thanks so much for having me.
What is the reality for these companies that have these big, and they are big spaces? I was looking, I think the average number is about 200,000 square feet.
The reality at the end of the day is really that one cannot depend on some of these large traditional department stores coming back to these spaces. And I'm not saying there isn't a future for retail, but it has to be a right-sized future for retail. And I think also, just to add to that, it's something to consider from a point of view of understanding what other uses could potentially go into that space. And determining what those are is really where the trick comes in.
And what should they be looking for? Are they looking for more retail, or are there other options?
There's definitely more other options, and therein lies the secret. It's about understanding demand. It's about also understanding how that demand and the key characteristics of that demand of whatever use we're speaking of maps onto what the existing property is today and what it can be in the future.
I mean, are you talking essentially turning them almost into community hubs in a way?
It could be it could be a lot of different things. Let's run through one potential scenario. If you look at demand on the one side, look at various different uses, what does the market need at the moment? Absolutely, housing is one, but affordability on the other side is a problem. How do you make the numbers work? How do you make it work financially? That's a problem. That's an issue. One other thing that comes to mind is the boom in data centers. Is there maybe a potential for a portion of building to become another use such as that? Obviously, power demand and everything else is required. But what I'm getting at is really to dig into the numbers, dig into the data, the demand, and then marry that up to the existing building and the existing uses. For example, if we speak about Hudson's Bay, could the deep spaces be some sort of less exterior facing use, like a data center? Could we then also introduce retail at street level in order to activate the streets, bring vibrancy and activity back to the city? Why? Because that impacts safety, impacts value, and all sorts of different city level characteristics. But then also, very importantly, understand what can happen to the property in the long term in order to maximize long-term value and potential. So could you in future even densify the site, add potentially office, hotel uses, and so on into this type of property in order to continue to grow and meet different market demands? But you can only do that if you really understand what you need to prepare for, what you need to bring to the site today, and then introduce later in time.
What should they be looking for? What should they be thinking about?
They really need to look for which uses will provide the best return today. Firstly, what does that look like? What does that mean for them? How can that map onto what the existing building is? How can you implement that? And then taking a number of years out into the future, looking at that, what is the absorption? What is the demand for different uses? Other uses look like? Identify what those individual uses can be, because you don't have, none of us have a crystal ball. We can't determine what those uses be for sure. We can muse and we can prepare for potentially office, residential, hotel, or whatever the case is. And then within reason, make provision for those uses.
And are we seeing any of these companies doing that yet with some of the space? I mean, it's been almost a year. Are we starting to see some of them do conversions along the lines of what you're recommending?
Absolutely. It's interesting that a number of years ago, the Eaton Center Sears space, when that space was vacated, we actually provided and put together a concept to turn a portion of the building into office space, which BMO ended up occupying. And then more recently, when Nordstrom vacated the space, we actually right-sized, introduced Simons into a portion of the Nordstrom space, and also Italy. So that's a very recent example of this type of approach. Over time, understanding what that capability, or at least the potential is within a property, and then introduce those uses as the need arises and as the market comes into needing that type of solution.
It sounds like, I mean, it sounds a bit of a joke, but it sounds like you have to think outside the box, because these are big boxes that give you all kinds of options. The options are almost endless if you look at it that way.
Absolutely. The options are endless, but one needs to be realistic in targeting the correct uses. And the correct uses, or the answer at least for targeting the correct uses, comes out of understanding what is needed in the market, and then marrying that with the property, be it an existing building, be it a vacant lot, in order to come up with the correct solution. And then final kind of piece to it is when you need to execute, when you need to actually push the button to make that happen.
Okay. Dwayne, thank you very much for joining us today. We appreciate it.
Thank you so much.
Dwayne Render is City Studio Director and Senior Associate at Gensler. Coming up, Canadian miner Lundin Gold had record production in its latest quarter and also announced a major new copper discovery. We'll hear from the company's CEO when we come back. Canadian mining company Lundin Gold recently reported its fourth quarter and full year 2025 operating results. We sat down with Jamie Beck, President and CEO of Lundin, to discuss the company's plan for its soaring cash as they eye copper mining.
We actually raised our guidance bottom end to 490, so we eked in above that. I think we were trending north of 500,000 ounces, and an unexpected ball mill gearbox issue right over the Christmas holidays put us out for a couple of days. But still super pleased with where we managed to finish the year.
And you're happy. You're one of the richest mines of your size in the world. What are you, north of 8 grams a ton?
Yeah, we're planning for 2026 mining 8.3 grams per ton from underground, and that's actually down. I mean, the mine's now been operating for about 6 years, and so you're starting to see some of the grades drop off a little bit from the early years at Fruta del Norte, but still an absolute remarkable discovery and deposit.
So talk to us about this flood of cash you've got coming in. BMO, as I mentioned, sees your cash flow last year at almost $4 a share. And next year, depending what happens to gold prices, potentially going to almost $6 a share. So you're piling up cash like other producers right now.
Well, we're not really, Andrew. We're making a lot of cash, but I think what separates us from some of the other producers is that we're giving it back to shareholders. We have one of the highest dividend yields in the market. We have a fixed dividend of 30 cents a share, and we've got a variable dividend, which is a minimum of 50% of free cash flow. That we're returning all of that cash back to shareholders. Last quarter, we actually paid out 100% of our free cash flow back to shareholders as well. So, we've got cash levels at an appropriate position. And until such time as we need more, we're going to return that money back to shareholders.
That's interesting. I mean, other gold miners, I haven't seen a flood of big dividends and special dividends and dividend increases from the industry so far anyway.
Yeah, I think that's, when you take a look at our performance, obviously the underlying business is performing incredibly well, but I think the shares have performed well, largely a result of our capital allocation strategy. And I think investors are appreciating the money coming back into their hands.
Yeah, you've done well. I mean, if you put up a comparative chart with you versus the gold index, the gold stock index, and that even excluding the dividend that you've been paying, it looks pretty over 5 years.
It's been a great story and a tribute to the team for quality execution on a great plan.
You found copper. You found some, what you say could be a huge copper deposit late last year. Of course, it will take years for you to actually get into anything like production of copper.
Well, yeah, hopefully sooner than later.
Okay.
Right? We're trying to figure out what that means, but certainly the indications are these are district scale copper discoveries. We have had multiple porphyry centers now discovered, and these are nearby Fruta del Norte's mine. So this is 1, 2, 3 kilometers away, and we're getting intersections that are 600 to 800 meters deep, 1,000 meters along strike, 500 meters in width. So we're still sort of trying to understand the full extent of what we're onto here, but it's incredibly exciting. This no question will ultimately be an area of the world that produces a significant amount of copper alongside our gold operation.
It's interesting. Ecuador, long thought to be a tricky part of the world to produce gold, politically tricky. I see DPM Mining was running into big protests late last year. Tens of thousands of residents not happy about a mining project that DPM, TSX-listed Dundee, had. I know you don't want to probably comment on DPM, but so far you seem to be avoiding protests.
We've had such strong support locally. I was just in country and had a chance to visit with so many of the stakeholders in Zamora Chinchipe, which is the province in southeastern Ecuador where we are. They've been incredibly supportive of our project, and we've got solid agreements that the Ecuadorian government has stood behind. So, I think there's always political noise, and Ecuador is choppy like many other places in the world, but we've been able to navigate so far successfully, and I'm just thrilled with the relationship we do have in country with our stakeholders.
And he was speaking with Jamie Beck, President and CEO of Lundin Gold. Coming up, luxury retailer Saks Global has filed for bankruptcy, and there's a Canadian connection. Lindsay Biscaya will break it down after the break. Luxury retailer Saks Global has announced it is filing for bankruptcy. For more on this, we're joined by BNN Bloomberg's Lindsay Biscaya. And Lindsay, another one falls. It's tough to see, but the big department stores struggling.
Yeah, the big department stores are struggling. We've seen that quite a bit over the last couple of years. But when it comes to Saks Global, the owner of Saks Fifth Avenue, they've filed for bankruptcy, Chapter 11 bankruptcy, which gives them time to kind of reorganize. And it comes after, they have been struggling. Many department stores have, with competition, particularly online, but also massive debt because they bought Neiman Marcus in 2024. That was the rival. It cost $2.65 billion US for that acquisition. And since then, you've seen Saks Global struggling. This also comes after a change in CEO. Richard Baker had taken over as CEO and executive chairman just earlier this month after the former CEO stepped down. Richard Baker now walking away with a new CEO in place to move forward. But Richard Baker is someone who's really interesting to watch because he bought when we're talking about department stores in total, like he bought Lord & Taylor in 2006. He then acquired Hudson's Bay in 2008. He helped to turn both of those stores around for years before Hudson's Bay started to go downhill, particularly in 2019 when he tried to move them into the Netherlands as well, like launch them into the Netherlands. That didn't work. We all know what happened with Hudson's Bay. And then he also sold Lord & Taylor, with that chain folding soon after. And he was behind Saks buying Neiman Marcus in 2024 because Hudson's Bay was also the owner of Saks at the time. So it's all intermingled. It's all quite confusing. But I mean, he has a very long history of these wins and loses when it comes to trying to get department stores back on track. To give him credit, he does manage to get most back on track. But he is sometimes there when they start to fall as well.
So where's he going next? Should we be?
Well, yeah, I guess we should be looking into where he's going next or what his plans are. Because when you look at the future of department stores, it's not dead per se. It's just changing.
And with we just talked about some of the ones that have gone under. Any others on shaky ground, or what looks like the future for them?
Well, I mean, at this point, like there are some others that seem to be on shaky ground. I mean, if you wanted to put names out there, like there's some that are you just kind of notice when you look at what they're doing, like Nordstrom, Macy's is changing where it ships and everything like that. But in particular, when you're looking at luxury department, that's where you're seeing quite a big change. Studies have shown global sales of luxury goods are expected to contract in 2026 for a second straight year. People just aren't spending as much money. And we're seeing that with a lot of department stores. And I know we were speaking earlier with Jack Manley with Morgan Asset Management, and he was saying the demise of brick and mortar really started around COVID, of course, when people started buying online. But he says retail isn't dead. You just have to do it differently. And he kind of explained what that means. Take a listen.
Adding something to the mix. What's working in retail? I mean, it's where your nail salon is or your fitness studio is. It's where the movie theater is, the arcade, the brewery. That pocket of retail has actually done quite nicely. The other pocket of retail that's done quite well for quite some time has been the luxury side of things. Because, if you're going to be spending a lot of money on something, whatever it happens to be, a handbag, a watch, a suit, a car, generally speaking, you want to touch the thing, right? You want to see it in person. You want to be there and experience that good before you lay your cold, hard money down on the table and purchase the thing.
And Manley also noted when it comes to luxury retail, usually you think like small boutique, very intimate, not 4 to 7 story buildings, right? Big buildings. When it comes for Saks, just very quickly, the company says stores will remain open as it works to kind of restructure some of that company debt.
Okay, we'll see where it goes. BNN Bloomberg's Lindsay Biscaya. Thank you as always. A recent study says that 15% of Canadian snowbirds are no longer wintering in the U.S. For more, we were joined earlier by CTV's Scott Hurst to discuss the reasons behind Canadian snowbirds shunning the States.
Canadians not traveling as much to the United States, although there are still a significant portion of Canadians who continue to travel to the U.S. But now the focus really, because of the time of year, is on snowbirds. And this recent survey focusing mostly on retirees, saying about 12 to 15% are deciding not to travel to the United States through the winter months. And many of the reasons include, of course, as you might expect, because it gets a lot of headlines, is the political climate for one reason, trade tensions with the U.S. and ongoing threats from the Trump administration. Also, another big factor is confusion around changes to border requirements, leading to a lot of questions about many people crossing the border and what they may have to do or may be required to do. But also, of course, the weak loonie, the poor Canadian performance, the poor performance of the Canadian dollar against the greenback, of course. That's a huge drain on the overall cost. And, when you go to a trip to the U.S. for several months, for that matter, 4, 5, 6, 7, 8 weeks, it's the day-to-day expenses that add up with the exchange rate. So that is another big factor as well. But of course, this doesn't mean nobody's crossing. According to this recent survey, it still shows that about 70% of respondents are still planning to head south to these popular U.S. destinations that we all are aware of, like Arizona, Florida, Texas, California. And they're still going for a lot of reasons. Of course, Canadians might have investments in the U.S., real estate. They might have a second home in the U.S. and want to make sure that they are able to use that home. But also for Canadians who spent many years, if not decades, going to these popular U.S. destinations, they, of course, have built up a community down there and do feel welcome and do feel comfortable going to the U.S. right now, despite the current political climate, Andrew.
any indication of where people are going ahead, going instead? I've heard Oaxaca in Mexico is a big destination for Canadians.
Well, with the deep freeze coming to Toronto, that'll be a big choice for you and I to think about potentially going there. But yeah, Mexico is, of course, a big spot for Canadians. Costa Rica, we're hearing as well. Other spots in the Caribbean, including Portugal and Spain. And we've seen this also in recent StatsCan numbers as well in terms of Canadians flying back to this country. Trips from the U.S. by air in the most recent numbers are down close to 20%, but Canadians are, of course, still traveling, as we've seen return trips from other places overseas are up 10% from these overseas destinations.
All right, that was CTV's Scott Hurst. Know your options back. Tune in today at 3 p.m. Eastern to have all of your options trading questions answered by Chris Tom of Moat Financial. Send us your questions at knowyouroptions@bnnbloomberg.ca. Market Call is coming up next, and today on the show we have Bruce Campbell. He's the president and portfolio manager at Stonecastle Investment Management, and we'll be taking your questions on Canadian stocks. And let's take a quick look at the markets and see how they are shaping up right now. It's kind of looking like we might see another down day. The TSX almost was back into the green, but now it's off again by about 0.33%, though. One of the ones doing all right, though, I want to pull up Nutrien. Take a look at how it's doing right now. It is up a little more than 7%. This on Morgan Stanley, upgrading it from overweight to overweight from equal weight. The analyst notes higher earnings. Potash demand is expected to grow, and that is pushing Nutrien up nicely. Now, south of the border, we are looking at another off day as well. It doesn't look like anybody's bouncing back there at all. The S&P 500, it is off by 1.1% almost. The Dow off by 0.67%. And NASDAQ is up by 1.63%. The three of the banks reporting, and they are taking hits right now. That's dragging things down. And, of course, the one last thing, there we go. We got the banks for you. You can see Bank of America, they all had good reports, but some concerns, and they're off by 5% on average. That's it for Morning Markets. We'll see you back here tomorrow. Have yourself a great day.